All right, I'd just like to welcome everyone to our first conversation piece. And today we've got Ryan Neary from GSA Insurance Brokers. Ryan's recently helped Chartreux through their PI renewal. And there's been some major changes in the space of PI. So I thought it would be a good idea to have a bit of a chat with Ryan to give everyone else in the industry a bit of a lowdown of what's happening out there and what they're going to face when they go to renew their own PI cover. So, g'day Ryan, and mate, thanks for having a chat with us.
No worries, Rob. Thanks for having me.
Mate, what's going on in the PI market?
Mate, you've just experienced it through your renewal. I mean, the PI market runs in cycles, and it's a very cycle-based industry. And at the moment, we're in what's known as a hard cycle. And I think we're at sort of at the start to the midway through the hard cycle. I still think there's a while to go, and that's where we're currently at. I suppose this hard cycle has been driven by a number of things. Obviously, claims activity is what drives these things first and foremost, but there's been some other items that have driven this particular hard cycle, and it's sort of the imperfect storm that we've found ourselves in. I mean, first you had the Hayne Royal Commission and the findings out of that, and obviously that highlighted vertical integration, fee for no service, items such as that also enhanced the regulator's focus on the industry, which concerns insurers. The Lloyds market over in London has been a big player in providing capacity to financial planners for years. Probably a year and a half to 2 years ago, the Lloyds head office did a thematic review or undertook a thematic review of each of their syndicates. The findings of that were that international professional indemnity insurance, which does include Australia, was their second biggest loss leader globally. The remediation plan that was a result of this review was that each syndicate that were providing capacity in the classes that were loss leading for Lloyds needed to put together a business plan and submit that to them and get their approval. That business plan was more of a remediation plan to show them how they could continue to write this business profitably for the next few years. And as some of the items that were covered in those remediation plans, some of the outcomes of those remediation plans were Lloyd syndicates that were providing PI had to reduce their limits, so reduce the level of capacity that they were putting out, increase their excesses, and obviously increase premiums. If they were unable to justify to Lloyds that they could continue to write this business and didn't get their business plan signed off, they would ultimately have to go into runoff. And over the past 24 months, more recently the last 12 months, we've seen a number of syndicates that were quite active in this space in providing capacity to financial planners and investment groups remove themselves and go into runoff and no longer are an option. And the third point and the most recent point is COVID. And COVID in the short term is okay, but in the long term and the uncertainty that it creates is what insurers and what underwriters are concerned about. And it's sort of caused us to see an even further shift in the market in the last 2 months. Obviously, when all the stimulus packages are removed in September and we understand where the economy sits, if there is a significant economic downturn, historically that normally results in claims and increased claims and notifications of claims against advisors because people have lost money on their investments. So that is what insurers are concerned about. It's the uncertainty that a significant economic downturn brings. And then another item is AFCA and obviously the increase in complaints and matters that AFCA are handling. And the changes in AFCA and, you know, the levels of claims and settlements that they can now handle. I mean, they can now handle settlements up to $500,000, whereas previously it was a lot less than that. So that is also creating some concern for insurers and causing them to, rethink their underwriting strategies around this sector and around this profession.
Yeah. That was definitely something that I sort of picked up in my discussions with a number of underwriters throughout the process. That's for sure. Now, Ryan, we might just go back to the Lloyds position. Now, my understanding was that there wasn't a hell of a lot of players willing to take on financial planning type risks in the first place. Now that we've got Lloyds or a number of syndicates within Lloyds pulling out of that market, what sort of impact is that having on, indeed, being able to approach potential insurers?
I think it has a huge impact, and we sort of witnessed that and experienced that throughout your renewal when one of the Lloyds syndicates, who was one of the insurers and one of the lead insurers on your program, went into runoff, and therefore when they go into runoff, they have no capabilities and no capacity to provide any solution whatsoever moving forward. So you have to find a replacement for that lead insurer or for that excess capacity wherever they're sitting on the program. And Lloyds were quite a large player in this market over the past few years. You had markets such as Antares, Manchester Underwriting, Landmark Underwriting, Acapella, who have now all gone into runoff. So, they were big capacity providers, and where you have to replace that capacity with is the local markets. And what we're finding is, as I said earlier, we are in a hard cycle. So what are sort of, I suppose, features of a hard cycle? Are premium increases, are excess increases, are reductions in limits, but also reductions and restrictions in appetite from insurers. And that's what we're finding. We're finding that when we're taking what was a London-led risk into the local market, it's very difficult to secure capacity and a premium rate at the same level as what the London market was charging with the local market in the current environment that we're in. So through these London syndicates going into runoff, and especially these London syndicates which led some of these programs, it does create quite a difficult situation, because the local capacity, the local providers, the local insurers do have the capacity to provide a solution. However, their underwriting guidelines and their underwriting, I suppose, restrictions have increased. So the types of businesses that they're now looking to provide capacity to has reduced and has, I suppose, gone to more a limited state. So, for example, some insurers that used to write dealer groups and used to write large dealer groups as new business will no longer write them, or they will look at them very carefully, and you will need to go through a very extensive process in order to even get considered by one of these local insurers for them to deploy capacity and provide a solution. So, yeah, the effect of London and those Lloyds syndicates removing themselves from the market could have quite dramatic and material effects.
Yeah, well, I guess we sort of experienced that firsthand, I suppose, where our existing insurers pulled the pin, and then a lot of the other insurers that did have capacity, that were still in the game, had basically said, well, they'd wound back capacity to satisfy how they were going to stay in the game, if that makes sense. So whilst a lot of the guys were saying, well, we're happy to renew existing insurers risks, they're not necessarily looking for new risks. Would that be a fair statement?
Yeah, that's exactly right. I think the feedback and the communications that we're getting from insurers at the moment is they're in a consolidation phase with their portfolios in this space. And obviously, with the uncertainty that COVID brings, for them to bring on any new business and deploy any new capacity in this area, they need to be extremely comfortable with the risk and extremely comfortable with the policies and procedures and risk management and mitigants that company has in place. But even if that company has that all in place and is a quality business and has a clean claims record, there's no guarantee that any one of these local insurers is going to provide capacity, because they are in a, as I said, a consolidation phase, and what they're doing is they're trying to balance out their portfolios to ensure that they're not taking on any new business that could lead to enhanced risk in this unknown period that COVID brings. What we're also seeing with the local insurers is PI, especially around financial services, is on the radar of everyone. And that includes the radar of their head offices, and some of their head offices are based overseas. So on some of these lines of business, especially if they're taking a primary position, they require head office sign-off as well. So the whole process of what you need to go through now to secure an outcome is extremely, I suppose, what's the word I'm looking for, detailed, and takes a significant amount of time. And there is no guarantee. You know, I mean, as I said before, there are local insurers that have previously provided solutions for new capacity in regards to dealer groups, or in regards to other areas of concern, such as MDAs that insurers may have. And you know, as recent as 2 months ago, they've now looked at their underwriting strategy and restricted that even further. So I think businesses that are going through the renewal process in the next 3 to 6 months, that aren't a vanilla business and aren't an employee-based financial planning business with a pretty vanilla product list, may see some difficulty.
Yeah, you mentioned the fact that head office, which in a lot of instances might have been offshore, gets involved. As an ex, I guess, banker, we saw that sort of scenario play out many times, where the guys on the ground, whilst they might like the proposal that's put to them, as soon as head office have a strategy in mind and they've set a policy, it really doesn't matter what the guys on the front line are seeing. They're just not going. The head office aren't going to reverse their position, and I got the impression that there was a lot of that going on as well.
Yeah, there is a lot of that going on, and even if it doesn't go to head office, once you have an area of concern or an area of unknown, such as the FI PI market at the moment, or FI professional indemnity insurance market at the moment, I should say, if it doesn't go to head office, you know, even internally within the business, there's peer reviews that go on. I mean, it's very rare that one underwriter is going to have ultimate control or autonomy over a decision for a dealer group, especially when they're taking a primary position. So once again, you may have the line underwriter on the risk and have them okay with it, but they then have to take it through their peer review process or through head office sign off to get the final outcome and the final result, and that may not be forthcoming in the market that we're seeing.
Yeah, right. Now you just mentioned previously that anyone that hasn't got a vanilla business, they're the ones that might be sort of facing issues. Can you just spend a bit of time talking about the aspects of businesses which underwriters are going to be wary of in this environment?
Yeah, look, I think first and foremost, anyone with an authorised representative model is not going to be straightforward. I mean, the concern that underwriters have over an authorised representative model is control, and obviously control of those authorised representatives, especially if they're over a number of jurisdictions and operating in a number of different areas. Insurers in the past have seen claims arise from obviously AR networks. You may have a rogue AR, or there may be insufficient control procedures in place, which leads to an AR being able to go outside the guidelines and cause significant loss for not only the business, but in turn the insurers. So yeah, AR models are definitely on the radar. The dealer group model, obviously on the radar for insurers, and there is a very limited capacity for that space at the moment. Anything with any business with a managed discretionary account or an MDA attached to it is also a significant concern for insurers. And once again, the markets are extremely limited around who can provide capacity for this exposure. I suppose historically, insurers have always looked at the gearing of portfolios, and anyone with a heavy reliance on margin lending or gearing is going to be looked at closer than someone that isn't using a margin lending or gearing facility. Obviously, any risks that have claims or have had past notifications or claims paid out by insurers, that's an area of concern. And I mean, what I'd advise as well is every business has a complaints register, and a complaints register is an important part of the underwriting information, underwriting criteria that we need to build within our submission when we submit it to the market. If there are trends within the complaints register, and whether that's one advisor or one rep, one product, or one particular item that's leading to a number of these complaints, it would be advisable before you take any risk to the market that you look at what that trend is and look at ways that you can overcome that trend. Otherwise, once again, insurers are going to be very hesitant to deploy capital around that. We've also seen some hesitation from markets in regards to direct equities. So where sort of the planning group or the business are picking equities themselves and not using a managed portfolio type arrangement. So yeah, I mean, it's hard to pinpoint the exact items of what insurers look for, because each insurer and each underwriter have their own set of underwriting guidelines, and one business may look totally different from one insurer to the next. And that's why you need to go through the process and engage with as many as you can to understand what their appetite is around those certain areas. And if there are areas of concern, the underwriters will let you know, and that communication process will allow you to understand that. And if it's not an area that means it's an absolute decline for them, what I encourage is that you look at that area of concern that the insurer has and get as much information that you can to provide to them, and also engage with them in conversation, whether it's a meeting, a video conference, or a telephone call, to provide them a higher comfort level around those areas of concern that you have. Because in this hard market and in the market that we're currently in, they're the levels that you need to go to in order to obtain an outcome.
Yeah. Well, I must admit, I think this must have been about the 12th year that we've undertaken the process, and I did notice very, very clearly the focus that was on portfolios that advisors are implementing for their clients, and how the research and how those portfolios are put together. You mentioned the direct equities. Yeah, that was a focus that I must admit I've never seen in the past. And I also note that the regulator is also targeting that area as well. So I think that's probably something that's probably going to play out for the next couple of years, I would think. Yeah,
it's an important point. I mean, obviously, underwriters and insurers want to understand how businesses are choosing their products, and what process is being run, what due diligence is being undertaken before a product is actually accepted and put on the list. And you know, how are those products monitored, and how do you ensure that portfolio is diversified enough that where you don't have an area or a sector where you're too heavily weighted or over leveraged in, that could cause significant loss for not only the business but the insurers.
Yeah. So from a practical perspective, what is all this going to lead into for? I mean, at the end of the day, if a dealer group doesn't have a PI policy, it can't operate. So it's one of those easy decisions that you get to make in life, where basically you just have to accept the best offer that you can. What are the policies going to be looking like going forward, do you think, in regards to premiums, excesses, conditions, clauses? How is it going to change, do you think, over what it's been over the last couple of years?
I think there will definitely be significant change, and we've already seen some material changes, which, all the renewals that we're going through at the moment, including yours, Rob. And I go back to those items that I touched on earlier. There's obviously going to be increased premiums. The average increase that we're seeing on a vanilla advisor at the moment is probably about 30%. But then once they go into those areas that I've discussed earlier that are of concern of underwriters, you could be looking at increases up to 200 to 300%. We have seen that, and especially if you've got the situation where you've lost your primary or incumbent insurer because they've gone into runoff or have removed themselves from the market. In regards to excess, we've seen a steady increase in excess over the past 12 months from a minimum excess point of view. The minimum excesses for financial planners now is probably up around the $15,000 to $20,000 mark, where it used to be $5,000 to $10,000. However, on the larger businesses and the larger dealer groups and planning groups, insurers are encouraging the business to take on a higher excess to demonstrate that you have more skin in the game. And then they're more inclined to look at the business more favourably if you're willing to carry a higher excess. And we saw that through our negotiations with some of the London insurers that we spoke to, Rob, in our conversations. But then again, it comes down to the feasibility of a dealer group holding an excess of, $500,000 to $1 million per claim. How can that be passed down to the individual reps or the individual cars? They can't really handle that level of excess or deductible. So, you've got to look at alternate structures to try and somehow get around that. But increased excesses and increased premiums are definitely two things that we're going to see. In regards to exclusions, we haven't really seen at the moment insurers change their wordings too much around what they're willing to cover. Obviously, there are certain products that they're concerned about, such as, I suppose, direct property to an extent, agricultural funds, and things like that have always been a little bit of a concern, and they may place exclusions around advice into those products. And talking about leverage earlier and gearing, or MDAs and items of focus, they may place exclusions or not even or endorsements around those type of exposures to just ensure that the planners are remaining within their guidelines of either the gearing and the lending, the gearing or the leverage or the MDA, because obviously if you go outside of the guidelines, there's not going to be any coverage there. But I suppose in terms of the standard policy wordings that we're seeing from insurers, and the coverage that we're seeing, we're not seeing significant restrictions in cover at the moment. Insurers are trying to protect themselves in three ways, and that's a reduction in capacity, so managing the lines of limit that they have out. So you probably won't see a lot of insurers moving forward put out any limit higher than $2.5 million, whereas previously, they had limits of $5, $10, $20 million out there. That's been really scaled back. Obviously, the increases in excess and increases in premium and the portfolio correction is probably the major impacts that we're seeing at the moment.
Yeah, okay. So from a practical perspective, for people that are facing renewal coming up, what do they need to do to get ahead of all of this?
Oh, look, I think that the best advice that I can give is to start the process as early as possible. And when I say that, it will feel like you're renewing your policy and then going straight back into a renewal process. But I think that's, in this market, that's what you've got to do. So I think you need to start engaging with the market at least 4 months out from renewal, maybe even 5 months out. And that may not be a real detailed negotiation, but what that is doing is reaching out to each individual insurer, understanding their appetite for the risk that you have in front of you, and then identifying how many markets you're actually going to have to deal with throughout this renewal process. So starting the process early, first and foremost. engaging with the insurers. So historically, you know, you could complete a proposal form, provide some appendices such as, you know, your APL, your complaints register, you know, your claims history if you had claims, your policies and procedures around monitoring the reps, and that would be enough for an insurer to quote. And it might still be enough for some insurers to quote, but what I would really encourage is engaging with your insurers, whether it's your incumbent insurer or new insurers. In this COVID environment, it's very hard to have meetings, but whether it's a video conference or call, it just allows the insurer another platform to further understand the risk and increase their comfort level around the risk. And it will give you the best opportunity to get in an outcome with them. And also compile, as a business, you need to compile the most comprehensive submission that you can, including as much information you can. And I go back to what I spoke about earlier, reviewing your complaints register and seeing if there's any trends and managing those trends and being able to communicate to the insurance market, okay, we've identified these trends and this is what we're putting in place to fix what's happening. Also, you know, any audits that you've done internally, or even if you've got an external audit that shows that you don't have any fee for no service issues or any vertical integration issues. I mean, it's just about going that extra step and that extra step further than what you've had to do previously throughout this renewal process to get the best outcome.
Yeah, no, absolutely. It's I think that's very sound advice. Now, finally, mate, I just might just get your thoughts on this. The FPA recently stepped into a debate, or they started a debate around yet another regulatory proposed change for our industry. You'd sort of think that we probably would have ran out of energy for such things, but apparently not. Self-licensing, so having advisors individually licensed as opposed to the current structure. One of the things that I sort of thought about straight away, one of the big things that I thought about was, well, how are they going to get PI? What would be your thoughts in regards to that proposal and the PI aspects?
Look, I think if each advisor had to buy their own PI or purchase their own PI, it would create issues, because, I mean, one of the biggest issues that we have at the moment in the market, which I've spoken about earlier, is capacity. And you know, you look at a dealer group like yourself, and you've got 70 representatives underneath the license, and that's 70 people that don't have to go and purchase their own professional indemnity insurance policy. Now, you've got a certain level of limit out on your license, and that's shared amongst the reps. And that means that the insurer only has to put that limit out once. Whereas if the insurer was insuring 70 individuals, they'd have to deploy that limit 70 times. And I just don't think the capacity at the moment in this hard market that we find ourselves in is available. And I think it will create some issues if that's the path that they need to go down.
Yeah, well, it's probably yet another unintended consequence of people who have got great ideas on how to save the world. Unfortunately, the financial service industry seems to be full of it. Mate, there's been some great insight there, and I think it's important for the industry. So, mate, I want to thank you very much for participating. I do think that people need to be aware of what they're walking into potentially, and I think that's great advice. Get yourself nice and organised early. Get front and center, and try and get ahead of whatever it is you're going to face. So you're sort of not jamming yourself, because ultimately, if you don't have PI insurance, you can't have a license.
No, that's right. And I think I'll just finish on one more point, Rob, if I can.
Sure, mate.
I mean, all the things I've spoken about are pretty doom and gloom, because we are in a hard market. But you can still secure cover. There still are insurers out there that are right in this business. You know, there's just going to be premium increases. They're more selective in what they're taking on in terms of risk. But there still are solutions out there, and there still are insurers providing capacity. So It's just about starting the process early and securing the outcome as early as you can.
Well, and if anyone's indeed after a good broker, I can recommend Ryan. Ryan and the team at GSA, they did a fantastic job for us, and they were relentless and worked around the clock. Mate, I can't give you any more glowing endorsement than that.
Thanks, Robin. More than happy to help anyone out if they are if they are having any difficulties, or if they just want a fresh set of eyes to have a look at it for them.
Yeah, good on you, mate. Well, thanks heaps, Ryan, and mate, thanks for joining us.
Thanks, mate. Absolute pleasure.